Uh,
So, Doug, yeah, Ryan Prager coming back to A&M. I mean, that
yeah,
was shocking news.
yeah, man, I don't know what the bonuses they're paying for him in the third round, so I don't know if he's done a calculation on that. The big controversy with the coach leaving and going to Texas.
Mhm.
The day that the championship game was over, that was a pretty shocking event. My sons, who grew up there at Texas A&M when I was working my doctorate, are devout Texas Aggie fans, and oh my gosh, I almost couldn't talk to them. It was crazy.
Robbie's a Texas grad. I don't know if you know that. We should have probably covered that in the pre-show.
Oh yeah, well, we've I've aged and become more mellow, so
I think of that baseball coach. You Half the state hates him now with pure vitriol. How could he ever set foot anywhere near Aggie land again? The baseball coach, they're amazing.
yeah, it's going to be that was not well managed. But the college sports, in particular baseball, two things are very different. One is this portal thing where they can transfer around at any time. The second one is the major leagues cut way back on the number of minor league teams. So now you have a higher grade of talent at the college level because some of those will have to go to college because they won't be drafted into the limited number of minor leagues. The baseball has actually learned from football on that perspective because the NFL uses the college environment as a talent development tool for free. So
It's
baseball's moving in that direction.
interesting you say that. I've been thinking about that with Paul Skeens dominating the NL this
Mm-hmm.
year, straight out of LSU. And you would think that you as an economist, these numbers are interesting where there's a high A, a low A, a double A, a triple A, a major league team. You got 25 guys per roster, 30 teams. You're looking at a much larger pool of pro athletes in baseball than the NBA, which is G League and NBA, and maybe 12 guys a roster. And so
Right.
you'd argue that the talent pool is so much more diluted. And I think we're starting to
Yeah.
see that maybe in the NFL a little bit too. Some of these guys that make pro rosters, they're not as good as what it used to be.
Right. Yeah, I would agree.
All right, let's go ahead and get into it. I'm Rich Swerbinsky with Onward and Upward Consulting, and this is the big picture. Welcome. I want to join my co-host and with Dad doing some grandpa duties today. Pleased to have Robbie Chrisman on with us today. Robbie, good to see you
Always happy to join you, Rich.
in the mountains of Colorado.
Yeah, any fans of the show out here in Dolores, come say hi, come fly fishing later.
Good stuff.
Awesome.
Welcome to the show. And our guest this week, really pleased to be joined by Fannie Mae Senior Vice President and Chief Economist, Doug Duncan. Doug, great to see you. How are you doing today? And thanks for joining us.
Doing great. Thanks for the invite. Happy to be here. Love the backdrop. I'll try not to focus on fly fishing throughout here, but great to be with you. Lots to talk about.
And jumping on, Rob. Rob, good to see you. How's things?
Things are confusing for me. Apparently technology has passed me by, and I've been trying for the last 8 minutes to get on this call.
Well, you're on now. So let's go ahead and get into it. And going to start, Robbie, GDP this morning. Much better than expected, 2.8% GDP growth against expectations of about 1.9%. Consumer spending continues to carry the resilient American economy, and those calling for a recession not proven to be right so far. And it appears like we're heading towards the magical soft landing that the Fed has been talking about for so long, and in conjunction with a slightly better than expected jobless claims number this morning, really feels like we are really on our way towards a rate cut before the election, most likely in September. Robbie, what say you?
I say most people came on to see Doug speak, so I'll keep it brief. But I think before today's data points that it was about a 95, 97% certainty of a rate cut in September. This might have pushed it up to 99.9% of a rate cut certainty. My thought with it, when the like you mentioned, expectations were for it to be in the 1 to 2% range, and it coming in at 2.8. My first thought was we should see a revision lower in coming reprints of this. You get 2 or 3 prints of the GDP, a second estimate, third estimate, final revision, that sort of thing. But my big takeaway is that considering it is the fastest GDP growth rate we're likely to see going into the foreseeable future, it's good. It's exactly what the Fed wanted. But I'm gonna defer to my dad and Doug on this one.
I'll defer to Doug.
Yeah, it was Rich probably stated our forecast was for about a 1.9% growth rate. The American consumer is just never gets tired. Apparently, the consumption's been growing faster than income measures for a while now. Not all the consumers are doing that well. If you look at the lower income groups, their rise in their use of credit cards and the rollover of credit card balances has also started to push up serious delinquencies in that space. So there are some distributional differences in the consumption piece and there is some stress that's showing in the low end. The other couple of things that came out today that I think are useful, Robbie mentioned one thing from context. One other thing is the bankruptcy data came out and it's up pretty significantly. That's both on the personal side and on the business side, the highest it's been for quite some time. Part of that, I would argue, is the fact that much of the stimulus during the COVID period and post-COVID period has actually supported some firms, which now that those stimulus proceeds have passed through the system, are actually coming back and showing their real prospects. And then the durable goods numbers, which is always on the goods side of the economy, were significantly down. A big piece of that was the transportation numbers, which tend to be pretty volatile. So, but if you strip out the transportation numbers, it was still down between 2 and 3%, which suggests that the slowing, which is expected, there is some basis for the expectation of slowing of economic activity.
Doug, one question, something that's come up a lot recently is some of the historical precursors to recessions that we've seen over the course of the last year and a half, inverted yield curve for a certain period of time, consumer debt, to this point have not led to the recession that a lot of people thought was coming. Any general thoughts on just historical precursors to recessions and maybe why we haven't seen that this time around?
Yeah, a couple things. One is I've banished the use of the word normal. And the reason I did that is because I do think there were some fundamental structural issues that changed in the course of the pandemic and the public and private responses to the pandemic. So macroeconomists or people that have talked about economic activity have largely been comparing today's numbers to what was the case in 2019. I question whether that's relevant if in fact I'm right that there are some sustained structural shifts that have taken place in the economy. We'll only know that out into the future, but for example, the inverted yield curve is one that's been a classic since World War II. I think there are only a couple of instances where it did not precede a recession, and the conditions have tended to be that it was inverted significantly, like say 25 basis points or more, and for a long time period, like maybe 90 days or more. Well, we're at a year or more of curve inversion, and we still haven't seen the recession. The one thing I would say is if you subdivide as your undergraduate economics text probably had you do between the goods economy and the financial sector. If you look just at the goods economy, I would argue that we actually have had a recession on that side of the economy. If you look at the employment numbers, they dropped off very significantly for roughly 9 months. I think there was a month in there where there was a burst of employment in that space. but certainly from an autos perspective, from a housing perspective, from those components of the goods part of the economy, there really was a recession. In the housing space, it sort of continues, even though house prices are up, still up a little bit. Sales numbers are way down from where they were. So other things, the index of leading economic indicators, which has been a really good predictor, is I think down. It's been in the negative territory for something like 18 months. Just a bunch of things, to your point, that traditionally have been associated with recession. It did not get there. I would argue that a lot of that has to do with the massive amount of transfers that took place, whether through incentives of tax credits to the business sector or transfers like the PPP, something like that. And the transfer, those transfers were deficit funded and allowed many households to clean up their balance sheets, add to that very low interest rates that people refinanced their mortgages to, which freed up free cash flow for them on a monthly basis. I think all of those things were part of the mix for why things did not behave the way they traditionally have.
Good stuff. And Rob, you've been all over this really since the beginning in terms of questioning if we would see the recession that many predict. Any thoughts on this morning's GDP numbers or any reaction to any of Doug's points there?
Well, Doug, I wanted to ask you it's kind of like the old quote about I forget which aging government official said many decades ago, I don't know what pornography is, but I know it when I see it. The definition of a recession, I mean, has it become more subjective? I thought that there's a board, a government regulatory board. You probably know the acronym or the initials of the board that says, okay, we're in a recession or we had a recession. They in effect tell us if we're in a recession or not.
Right.
Do you think that they are incorporating the very things that you just talked about, employment, housing, and so on, and saying, oh, I guess we're in a recession now? Or are they saying everything's not in a recession?
It is the National Bureau of Economic Research Business Cycle Dating Committee is the official name of the organization, which
there you go.
And it's about 7 macroeconomists, I think, at the moment. They look at a number of indicators. The one that gets the most coverage from the popular press perspective is typically if there are 2 consecutive quarters where GDP falls, then that ends up being an indicator of recession. It's not exclusively true. They do factor those in, but those are quarterly measures, which, as was noted at the outset of the program here, get revised twice after they're initially issued. They have at least 5 other items that they look at that are updated monthly, or where the data are collected monthly. And as you would imagine, consumption and employment and investment are all things that factor in prominently. They have not declared a recession. I'm not surprised because to the point of GDP and the consumer's health in the spending side of things, that they haven't seen the decline in consumption or in investment or in employment that would suggest that it rises to the level of a recession. But that doesn't mean consumers don't feel bad about things. And I cite an Uber driver that recently took me to the airport. He was asking what I did, and I told him, and he's like, man, when is this inflation going to end? And I said, well, what do you mean by that statement? And he said, well, I go to the grocery store and eggs are like, I don't know, $6 a dozen. And I'm like, has that price changed recently? He said, no, it's been there for a while. So the perception of the public is that proper perception is that costs rose, but their incomes did not rise to keep up with those costs. And so while economists measure inflation as the period over period rate of change in prices, consumers are looking at where prices are relative to where their income went, and they're really unhappy about it. So, and they're right, prices went up, they did not come back down. The pace of increase has slowed significantly, but as a general price level, it has not come down. And while incomes are rising, they haven't caught all the way up to that change in prices.
Well, certainly if so much of the economy is how you feel about things. If you feel that you don't have any money, then you don't have any money. If you feel that you're wealthy, you're wealthy. And typically in a recession, you see rates decline.
Yeah.
Now, granted, rates have been declining to some extent here. The 10 years down, the yield curve is becoming less inverted. And so, it's nice to see rates come down a little bit, maybe perhaps in anticipation of a truly slowing economy. But Doug, to your earlier point, I would agree 100% in that, once again, we were looking at the haves and the have-nots, and the economy is impacting those different segments differently, just like, homeowners, especially those with 2 3/4 or 3% loans, the psychology of that homeowner, on the train, on the housing train, watching it appreciate, and with a low interest rate, the mentality of that, or the psychology of that, impacts so much of just their daily spending, probably, and whether or not they want to go on a vacation.
Yep. Yeah, and if you've been on the airplanes, they're on vacation.
Yeah.
Yeah, it is very much housing is very much a tale of the haves and the have-nots. So those folks that were in and were able to take advantage of lifetime low interest rates, it did so in huge numbers, and freed up cash flow for them that will sustain as long as they retain that mortgage, and lots of them are retaining those mortgages. The next generation, which we just heard from, is they're stressed out by rates and prices. Oops, I'm sorry, you were muted.
Two generations down. We may have a guest appearance here in a few seconds.
Okay.
Someone needs a nap, and I may have to get off the phone here, or the call here. But
you need a nap too.
Here's Robbie's niece.
Nice. Awesome.
Very good. This is The Big Picture, and really pleased this week to be joined by Fannie Mae Senior Vice President and Chief Economist. 16 years now at Fannie, Doug, and before that, 16 years as the MBA's Chief Economist. So
yeah,
not one more 16-year run somewhere else, and
No, the end is December. I'm actually retiring in December. I'm going to step down as Chief Economist in September. Mark Palin, my deputy, is going to be promoted into that job, and then I'll, after a brief transition, I'll step away. So, yeah, it's been a great place to be. People ask me, why did you spend your career in housing? It's really actually a truthful and simple answer. Every human on the planet puts their head down every night on a piece of real estate somewhere, and that will always be true. So it's actually a great business to be in, because it's part of the human story. And I've always enjoyed it for that, for all these years. And I'm sure I'll find some way to hang around the periphery.
And of the Fannie Mae's Economic and Strategic Research Group that you lead, Doug, just released the most recent update to the Fannie Mae housing market and economic outlook forecast. Some items of note in there, expecting home price growth to moderate a little bit, expecting new home sales to wane for a lot of the reasons we've been talking about on this show. Existing home sales, though, revised upward a little bit, as well as some projections in there just on interest rates and overall 1 to 4 family volume. Any items of note, Doug, from this most recent update in terms of things that the group changed its tone on, or just things that to point out from the most recent report?
A couple of things. One, we expect the Fed to cut in September. We don't really think the GDP number is going to change that. We think that the labor market is moving the way the Fed wants it to, and they've said that pretty explicitly. We do also think they'll cut in December, but I would note that if you look at our forecast over the next year, you'll see that we see only slow rate cuts, because we think part of the Fed's higher for longer story is not just that they would hold the discount rate, or I mean the Fed funds target rate at that level for a significant time period, but also when they ease, they will ease more slowly and less far than people expect. Second thing I would say is over the last couple of months, people have asked me in different venues, are there any data points that bother you? And there was one which I said that bothers me more than others, which was that in terms of completed new homes available for sale, the inventory is at a couple of decades high. And so I have to ask the question, if supply is our biggest problem, then why would it be that the inventory of completed new homes for sale would be at very high levels? Then that leads to looking at the level of supply that's under construction, and it's even higher. And so you have to say, maybe you've exhausted those folks that were in a position financially to make a move, and more of that impulse has been satisfied, and there is an underlying slowing taking place, which we did see. The most recent existing home sales were down to very low levels. And so it could be that just the pace at which prices increased and the level at which they have stayed, which is still rising slightly, combined with that rise in interest rates, has to some degree exhausted the pool of eligible borrowers, or at least at the margins. So those would be a couple things.
Supply less of an issue, noted in the report. 30% increase in just home listings since the last time that it was released. But to your point, still obviously some affordability impediments that the market is struggling with, and that is going to lead to continued home price increases. Right now, we're kind of still chugging along at about a 7% annualized value increase. Doug, I think in the report you projected that to end the year in the low 6s, where I think the most recent report was annualized, and I think it was 3% home price growth next year.
Yeah, something like that. Down to pretty much near to the pace of inflation. If you go back to the very long time frame from World War II, let's say after the VA was in full operation out until about the year 2000, the pace of annual price appreciation was around 3.5%. And over that time period, inflation averaged right around 3%. So in real terms, you got about 0.5% annual increase, which was enough to encourage builders to continue building supply. So it wouldn't be unrealistic historically to see the pace of house prices come back to that 3% range. So it's kind of a reasonable thing.
Doug, I saw something the other day, I wrote about it, saying that the price of existing home sales is exceeding the price of new home sales for only the second time in the last 25 years. And the other two, 2005 or 6 and 2019, existing home prices went boom shortly thereafter, with the next 6 months. Obviously, you're paid to forecast these things. Do you see that coming to fruition again, some shape or form?
Well, I think that to my comments about it on the new home supply, and the rise that we're seeing in the existing homes supply, which is heavily concentrated in Texas and Florida, but not exclusively, those suggest that some of the fundamentals are making an adjustment. While we've been looking at a little bit of data to try to understand, is there a floor to the level of activity from a sales perspective, just based on demographic needs? And it does sort of seem like a 4,000 existing home sales, 4 million existing home sales is sort of a floor, although the most recent annualized data were about 3.9 million, just under that. The demographics for housing are still pretty solid for another decade. And then, of course, it will depend after that on what happens with immigration. So it's hard to see a big drop off from a demographic perspective, but that doesn't mean affordability doesn't impact it. You have a couple of other things that are going on. One is there has attention recently been turned because of climate-related issues to insurance costs. And for sure, insurance costs have been rising. So it's not just the mortgage payment, but it's the related services related to the mortgage payment, like home insurance, homeowners insurance, like property taxes, things like that, which have also been rising and impinging affordability. So you take Florida with Hurricane Ian, sort of got the hurricane and flood insurance on everyone's mind. Texas, it's less that. Texas, it's probably more about the build out of supply, which they've been building houses like crazy in Texas, and that leading to some flattening of prices in that space. So, we'll see where those factors play out, but certainly in those two states, I would say that's part of the story.
Everybody's favorite topic, interest rates, Doug. I think your projection called for an average of 6.4% on the 30-year fixed rate next year. And to what you spoke to earlier, 2 Fed cuts here in 24 and then, continued more gradually slowing cuts as we get into 25.
Excuse me. Yeah, we had started the year of 2024 or ended 2023's forecast period, I think, with the idea that mortgage rates would be down around 6% by the end of 2024. But growth was stronger than what we had in our forecast as well. And the Fed did what they said. We believed them and embedded that, but we under anticipated the level of growth. So mortgage rates have stayed higher. I think over the course of this year, our expectation is, including those rate cuts from the Fed, that mortgage rates will have averaged about 6.8 across the full year, and then drop about 50 basis points as an average in 2025, when we think that there'll be another 3 or maybe 4 Fed rate cuts. We'll see where that goes. The part of the reason that our rate scenario has stayed somewhat higher than others is you have to make a decision today about how you think the federal government's need to fund the outstanding debt and the additional deficits that we're running, and how that will impact the yield curve, both in its in the level and the shape of that curve. And we think that it will put upward pressure on the underlying treasury curve across the curve, and that suggests that mortgage rates, which are a spread off of that, won't be able to come down as much as some think. That's a decision that we made. Other forecasters can make other decisions on that, but we do think that it is a factor. And in part, a couple of weeks ago, we saw a day in which rates shifted fairly significantly. It was, in my view, that the market became convinced the Fed was for sure going to cut rates in September. And they made a political decision that Trump was likely to be elected and his policies were more likely to be inflationary than the administration's policies. Now, whether that gets walked back at all, given the change with President Biden dropping out of the race or not, that remains to be seen. I'm bad enough at forecasting interest rates. I don't forecast politics, so I'll leave that to somebody else. But I believe that's the market. That was the market's thinking. And if, given that shift in the curve, the Fed does cut rates 2 times this year, very possibly it will uninvert. And there's a couple of analysts who have made the point that actually recessions don't start until the curve actually uninverts after a period of inversion. So for those who still want to think about some of the traditional indicators, that's one little thing to put in your back pocket.
As you noted, Doug, the one thing I think that caught us all off guard just with the economy this year is, economic growth fueled by consumer spending and leading to just stickier than we thought inflation and these delayed Fed cuts. Any just, personal theories on the American consumers just dogged spending into the teeth of inflation? Is it just, a lot of the loose money of the pandemic and spending habits changing and maybe not adjusting in an inflationary environment in the wake of that?
I think there's, for me, I don't doubt that the income transfers that were made were a big factor. And part of the reason we have these big deficits is that we transferred income to households so that they could improve their financial posture at the cost of the public now bearing a much higher level of debt that will ultimately have to be defeased. So we've traded some perhaps future growth for current growth, and we will see. The willingness to carry balances on credit cards, which have historically high average interest rates, they're the highest they've ever been. That is, to me, that's a troubling number. And Rob was saying earlier, I guess maybe I mentioned it too, that there is a distributional aspect to that. And the inflation certainly drove up the cost of those things which you have to have as a household, like food. Energy has not gone as far. That's been, thankfully, fairly stable in terms of the gasoline price. It had risen for a bit and it came back down. It's stayed fairly stable, so that's not so bad. But some of those staples, electricity costs are going up. Some of the things that households have to run, they're forced to spend more on them just because it's what's required to make their household run. And to the extent that some of them don't have the cash to pay for that, they're running it onto their credit cards, and that's troubling. So, but the transfers, one little nuance to think about. Never before had the federal government used their knowledge of your checking account as delivered through your IRS tax forms to give you a direct transfer of cash into your account. That's an interesting innovation from a governance perspective. It will be interesting to see how that gets utilized in the future in stimulus planning when the federal government wants to provide some sort of a stimulus, a direct cash infusion, which the next day is available to spend. That's an interesting innovation. And certainly that did help support spending during the course of the pandemic and the recovery from the pandemic.
Doug, I wanted to ask quickly about tomorrow's personal income and spending report. Based on today's GDP that came in much stronger than expected, almost double some estimates. Is there going to be a new bias for firmer kind of June core inflation or higher personal spending in the report tomorrow? And I only asked that because before we came on the show, you said if you're going to forecast often. So I'm going to let you.
And on the fly update. Well, part of the reason GDP was higher was inventory. And inventory is affected sometimes by the number of days in the cycle, by vagaries of shipping and production processes, and it tends to be one of the more volatile components of GDP. I agree with the statement that you made earlier, maybe before we were on, about the revisions, because this is the first release of GDP. I would agree with what I think you were saying, which is that likely, to the extent it gets revised, it'll be revised downward. I would agree with that. That said, they're not going to revise away all the consumer spending. It may get revised, but it's still a stronger number, significantly stronger number than was expected. Part of it depends on what we see in the employment report at the beginning of the month. It's always the first Friday of the month. We'll get actually a better look at the consumer and the consumer's prospects from that. However, there's this very wide divergence between what the establishment portion of that survey says and what the household portion of that survey says. They do diverge from time to time. They have in the past tended to resolve toward the household side, but the divergence is stark today. It's very wide. I'm not sure if it's ever been this wide. And the household side has been decidedly more pessimistic than the establishment side. And it's the household side from which the unemployment rate is derived. And that has been slowly marching upward. It's gone from 3.5 up to 4.1. And there's also an income report in that, and that income growth has been slowing. So I would say those things, if that trend continues, I would expect to see some downward revisions in the GDP numbers.
I have one quick follow-up about that. I think earlier in the show you had said we might not be in a services recession, but we're in a goods recession. And I don't know if that's exactly, what did you mean by that?
Yeah, you can divide the economy into the portion of the economy that produces things like automobiles and houses and fly rods and things. Exactly. So that would be the goods side of the economy. The services side is haircuts and dental visits and accounting services, things like that. The services side of the economy has been growing at well above what the Fed would accept as inflationary, but it's been averaged down by, for a period, an actual decline in the goods side. And Powell commented on that maybe 4 press conferences ago or something like that. He said the concern is that right now the headline measures of inflation are being averaged down by this negative contribution from the goods sector. And if that becomes positive again, then we will not have achieved our objectives on inflation. That's kind of why that mattered.
I'm not sure if I agree. I bought 7 of these rods this month alone. None of them seem to catch fish. I'm going to keep buying until I start catching fish.
Okay. Well, you can run a secondary market and use fly rods. And people will expect fish stories with them. So go ahead.
Yep. The big picture. We've got about 5 minutes left with Fannie Mae's Senior Vice President and Chief Economist, Doug Duncan. And shifting our focus for a moment, Robbie, got some big mortgage industry news this morning. New York Community Bank, a parent company of Flagstar Bank, Mr. Cooper, little shopping visit, 1.4 billion, picking up Flagstar's TPO and their mortgage servicing business. Pretty big news. Your thoughts when you saw that break this morning?
Well, my first thought was that companies of that size rarely make decisions based on emotion. It's on facts and economics, and so there's obviously a reason there. Hard quantitative reasoning that it happened. Flagstar been trending this way for a little while. You saw they canceled their retail channel last year. They've much like Wells Fargo, companies start to scale back, and it's almost like reading the tea leaves. We're slowly looking for maybe an out one way or another. In general, for the mortgage industry, it makes me think that M&A activity is going to continue throughout the rest of the year and into next year. Those are my big takeaways from a huge deal. It's and on top of that, it emphasizes the importance of a servicing book. We've seen a lot of mergers and acquisitions this year based on these big servicing portfolios, and this is another one of them.
Aggressive play by Cooper. PennyMac's been really aggressive and just different origination channels, and symptomatic of a changing landscape, Doug, just throughout your career. Like the big banks, like, they're just bopping in, bopping out of mortgage. Like, now we're in, now we're out. Just any perspective on just the large banks foray into and out of mortgage lending throughout the.
Well, it's a question of capital, right? And do they see the return that merits the risk that they take on, and with the capital that has to be held for that side of the business? I've followed Jamie Dimon a little bit. When he was at Bank One, before he went to Chase, he did not like mortgages, and as I recall, wanted out of them. Then now that he's at Chase, he's back in. Part of it is, are you a full service bank? That's, I think, one consideration. But I think some of the banks are thinking about what are the Basel implications, that the regulations in that space are not yet settled. But if you go back and take a ranking of the top 20 more companies in the mortgage business at the beginning of each decade for the last 7 decades, almost none of them are the same. It's an industry that has tremendous turnover over time. It's actually one of the things that's interesting about it. I don't know if people remember things like Lomas and Nettleman. Oh my gosh, there's a whole history of storied names. And Margaretten is one. Felix Beck and Margaretten. When I joined the mortgage bankers, Felix was the chairman that year, and he sold out the manufacturer in Hanover, which was bought by Chase, and then he ended up on the Chase board. Fascinating changes.
Interesting stuff. And
Rich, I know you have opinions on this deal. Since you sit here and you asked the question, but what came to mind for you when you saw this?
Just, to me, NYCB, they have a lot of exposure to real estate, multifamily, single family. It's a big servicing book and a big TPO business. And, they're obviously a publicly traded company. And, also just the lingering doubt, fear for, I guess, all banks on maybe commercial real estate and some of the things that could transpire in the future. So I think that was my take, was just, a bank in NYCB with just a lot of exposure to single and multifamily, and who knows, I know less about their exposure on the commercial side, but just taking some chips off the table was kind of the way I read it. So
yeah. I have one more thing for Doug while we have him. I'm sorry to commandeer your ship here. I'm decapping now. But Doug, since we got 1 minute left here, there's one of my favorite economic quotes. I think it's a Rudiger Dornbush quote. He said, in economics, things take longer to happen than you think they will, and they happen faster than you thought they could. What are your favorite economic quotes out there, or mottos that kind of ring through your head?
Oh gosh. Well, there's some that are humorous, but there's a a public truth to them. If you lay all the economists in the world end to end, they won't reach a conclusion. And that's basically about getting economists to make decisions. I use that with my own staff. If you're going to be in the business sector, you have to make decisions. Actually, from somebody in the mortgage industry, when I first got involved at the Mortgage Bankers Association, some of you may remember Leo Knight at National City Mortgage. Leo called me and asked me about a particular issue he was going to have to address his board on at 5 o'clock. He said, could you look at this and give me your thoughts? Maybe call me back around 3. I called him back and I said, you know, the data on this are not that great, but this is what it indicates. I look at this data, it's not that great. It sort of indicates this. He stopped me. He said, Doug, the data won't be better by 5 o'clock. And so I tell my staff when someone calls and asks for a decision, the data won't be better by 5 o'clock. But business people know that, right? And you still have to make decisions. So I credit Leo Knight, who's probably not in any of the economic textbooks, but I think it's a really important thing to know. You still have to decide.
Good stuff. And Doug, thank you so much for joining us this week on The Big Picture. As always, your insight, wit, really appreciate it, and really enjoyed the conversation, and appreciate you making some time out for us.
Thanks for inviting me. It's always great to talk with you guys. I always learn something myself.
You might have been outstaged though by Robbie's dog. That
was great. I love it.
That has just been working it back there in the north of Colorado. So, but good to see you.
Is that a fishing dog? Is he a fishing dog?
It's an Australian Shepherd. She
I got one of those.
see if she can herd some fish into the barrel for me so I can shoot them later. That'd be good.
Nice. Very good. Good to see you guys.
Good to see you, Doug. Good to see you, Robbie.
Right.
And thanks as always to our attendees. And we'll see you next week, Thursday, 3 p.m. Eastern on The Big Picture. Have a great rest of your week and weekend, everyone. Take care.
Bye-bye.